Picture this. The world's largest retail brokerage just posted its best quarter in company history, and the stock sold off. Welcome to Wall Street, where good news isn't always enough. I'm Hudson Thomas.
And I'm Lana Chen. Today we're going deep on Charles Schwab, ticker SCHW, and what a quarter it was. 9.9 million daily average trades, a record. Net interest income back above $3 billion, also a record. And client assets at $11.77 trillion.
That's 11 trillion with a T. To put that in perspective, that's roughly half the GDP of the United States sitting in Schwab's custody. And yet the stock dropped nearly 5% on earnings day. So what did the market not like? And is that an opportunity?
That's exactly what we're going to find out. Let's get into it.
So let's start from the beginning, because Schwab's story is genuinely one of the great American financial success stories. Charles Schwab, the man, founded the company in 1971 in San Francisco with a simple idea: make investing accessible to regular people. At the time, Wall Street ran on fat commissions and a general disdain for the retail investor. Schwab was the disruptor before disruption was a word.
And the company has been disrupting ever since. The big moment in modern history came in October 2019, when Schwab dropped commissions to zero on stock and ETF trades. That sent shockwaves through the industry and effectively forced every major online broker to follow. It was a calculated bet that volume and asset growth would more than compensate for lost commission revenue.
And then came the blockbuster deal. The $26 billion acquisition of TD Ameritrade closed in 2020. That deal more than doubled Schwab's client base overnight. 15 million TD Ameritrade accounts migrated onto the Schwab platform, and by late 2024, the integration was officially complete. $3 billion in annual cost synergies fully realized.
The result today is a company managing $11.77 trillion in client assets, up 19% year over year, with over 35 million active brokerage accounts. Schwab is the dominant custodian for independent registered investment advisors, the backbone of the independent wealth management industry.
They make money several ways. Net interest income, collecting the spread on cash clients keep in sweep accounts, is the biggest driver. Then there's asset management fees, trading-related revenue, and banking services. It's an integrated financial services machine.
One thing to understand about Schwab's business model is that scale is everything. The more assets they custody, the more interest they earn, the more fee revenue they generate. It's a virtuous cycle, and at $11.7 trillion, Schwab has a moat that's essentially impossible to replicate.
Leading this machine is a relatively new face at the top. Rick Wurster became president and CEO on January 1st, 2025, just over a year ago. Before the CEO title, he spent several years as president, and before that he built his career at Wellington Management and McKinsey. He's not a flashy personality, he's an executor.
And execution is exactly what Schwab needed. Wurster was the architect of the TD Ameritrade integration, the project that dominated the company for 4 years. He oversaw the migration of 15 million accounts, the consolidation of technology platforms, and the realization of those $3 billion in synergies. That's a genuinely hard operational lift, and it's done.
Analysts describe him as methodical and client-first, perfectly aligned with Schwab's culture. His playbook for 2026 is what he's calling Schwab 2.0, a relentless focus on cost efficiency and operating leverage. With the integration costs behind them, every revenue dollar now has more room to fall to the bottom line.
All right, let's talk numbers. And Hudson, this quarter was genuinely impressive across the board. Schwab reported total revenues of $7.3 billion for Q1 2026, which on a net basis, after interest expense, comes to $6.48 billion in net revenues. That's up 9.8% year over year on a gross basis.
And the earnings line?
GAAP earnings per share of $1.37. That's up 38% from 99 cents a year ago. On an adjusted basis, EPS came in at 143 versus the consensus estimate of 142, a penny beat.
So they beat adjusted estimates, but the stock sold off 5%. The market wanted more.
The market wanted more, yes. Expectations had crept higher heading into the print. But let's not lose the forest for the trees here. The absolute numbers are strong. Net interest income came in at $3.14 billion, which is the number I care most about for Schwab.
Walk me through why NII is the story.
So in 2022 and 2023, Schwab faced what the industry called cash sorting. When the Fed hiked rates aggressively, clients started moving cash out of Schwab's low-yield sweep accounts, where Schwab captures the interest spread, and into higher-yielding money market funds and T-bills. That crushed Schwab's NII. It fell from over $3 billion a quarter to as low as $2.2 billion in mid-2024.
A 30% decline in their most important revenue line.
Exactly. The bear thesis was that this cash sorting was structural, that clients had permanently wised up and would never keep as much cash in sweeps again. But what's happened is that as the Fed started cutting rates, money market yields have compressed and clients are drifting back to sweeps. Q1 2026 NII of $3.14 billion is up 16% from Q1 2025. That's the reversal playing out in real time.
What about the margin picture?
Operating margin on a trailing 12-month basis is 44.9%. Exceptional for a financial services company. Gross margin is 85.8%. Net margin is 33.3%. These are high-quality earnings from a business that has tremendous operating leverage as it grows.
And the balance sheet?
The balance sheet reflects the nature of a bank holding company, so the numbers are large. Total assets of $491 billion. The relevant thing for equity investors is the capital position. Schwab holds $46 billion in cash, $31 billion in total debt, and is actually in a net cash position of approximately $15 billion. Stockholders' equity of $49.4 billion. They bought back $2.8 billion in stock last year and paid $1.13 per share in dividends.
So overall financial health.
Overall, Schwab's financial health is strong. NII is recovering, margins are expanding, the balance sheet is solid, and the integration tailwinds are just beginning to flow to the income statement.
So what does Wall Street make of all this? Because the stock's reaction tells one story, but the analyst community might tell a different one.
Analyst Consensus sits at buy with 18 analysts covering the stock, 13 buys, 3 holds, and 1 lone sell. That's Bank of America, which has maintained an underperform rating for months on rate sensitivity concerns.
And the price targets?
Average target is $121, implying 32% upside from the current price, around $91.50. Morgan Stanley is the most bullish with a target of $135, reiterating overweight the morning after earnings. UBS is at $119, Barclays at $117, and Worthington Financial Research raised its target to $131 post-earnings.
So you've got a stock down nearly 5% on the day, with the analyst community calling it 30+% undervalued. That's a meaningful gap.
It is, and the stock was up significantly from its lows earlier in the year during rate uncertainty. The sell-off after earnings appears to be profit-taking by investors who had positioned for the beat rather than a fundamental reassessment.
Let's lay out both sides. I'll take the bull case first, and I have to say, it's compelling. The core thesis is simple. Schwab just completed a 4-year transformation, and the benefits are just beginning. The integration of TD Ameritrade is done, the cost base is set, and every incremental revenue dollar now flows through at high margins. The NII recovery is the biggest catalyst. Schwab's own guidance calls for $13.9 to $14.4 billion in net interest income for the full year. That would be a record, and it assumes continued stabilization of sweep deposits at current levels. If the Fed holds rates or cuts slowly, Schwab collects that full range. Trading volumes are another angle. 9.9 million daily average trades, a record by 34%, reflects a structurally more engaged retail investor base. Market volatility isn't going away, and Schwab captures revenue from every tick.
Now for the bear case, because there are real risks here. The interest rate sensitivity runs in both directions. Schwab's management acknowledges that every 25 basis point cut from the Fed costs approximately $100 million in annual NII. If the Fed gets aggressive with cuts, that NII guidance starts to look optimistic. The second bear concern is cash sorting resurgence. If money market yields spike relative to sweep rates for any reason, regulatory change, competitive pressure, clients could start moving cash out of sweeps again. That's the scenario that burned Schwab in 2022 and 2023, and the bears argue the structural vulnerability hasn't gone away. Finally, competition. Interactive Brokers is growing aggressively in international markets. Fidelity is privately held, never sleeps, and competes hard. And there's always the question of whether Schwab's zero-commission model generates enough revenue per client to justify the platform investment long-term.
Fair points on both sides. The bull case requires rate stability and continued sweep normalization. The bear case requires either Fed aggression or a return of the cash sorting dynamic. Let's see how Schwab stacks up against its closest peers. The comp set here is a little tricky because Schwab is genuinely unique, part brokerage, part bank, part asset manager. But let's use three names.
First, Interactive Brokers, IBKR. This is Schwab's most direct competitor in self-directed retail brokerage, particularly for active traders. IBKR trades at a price-to-sales ratio of about 14.2 times, significantly more expensive than Schwab at 5.7 times. The premium reflects IBKR's international growth story and their margin lending business.
So on that basis, Schwab looks cheap relative to IBKR.
It does. Now, Raymond James, RJF, is a different kind of competitor. They're an advisor-centric model with a large independent contractor network. RJF trades at about 1.8 times sales, a big discount to Schwab. But Raymond James doesn't have Schwab's NII machine or RIA custody scale, so that discount is earned.
And Morgan Stanley?
Morgan Stanley's wealth management division is probably the most direct competition at the high end, serving ultra-high net worth clients and RIAs. Morgan Stanley trades at about 3.15 times sales. Schwab trades at a premium. The market is paying for Schwab's growth in the self-directed and mass affluent segments.
The valuation picture looks reasonable for Schwab then, a premium to pure advisory models, but a discount to the most expensive growth brokers.
Looking at the options market, the picture reflects cautious optimism rather than clear directional conviction. The put-to-call ratio is 0.82, which is modestly elevated above the 60-day average. That tells you traders are spending slightly more on downside protection than usual, not panicking but not fully bullish either.
What's the options market's implied view on where the stock goes from here?
Open interest is concentrated at the $95 put strike and the $110 call strike, defining a near-term trading range in the market's view. Implied volatility is at the 45th percentile, which is manageable. The largest single block trade was a 5,000 contract put position at the 95 strike expiring in June, suggesting at least one large player is hedging toward that level.
On the insider front, the picture is unremarkable in the good way. Routine executive sales under pre-planned 10b5-1 programs totaled about $42 million in Q1, normal for a company of this size where compensation is heavily equity-based. 2 board members made open market purchases totaling about $1.8 million, which is a mild positive signal.
Importantly, there were no large discretionary sales from CEO Worster or CFO Mike Verdeschi, the people with the most insight into the business. That absence of selling from the top is more informative than the routine program sales.
All right, key risks and what to watch going forward. Lana, you flagged the big ones in the bear case. Rate sensitivity and cash sorting. What else?
Regulatory is a real wild card. The DOL fiduciary rule, if expanded, could require brokerages to pay clients more on sweep balances, which would directly compress Schwab's NII margins. That's been an overhang on the stock for years and hasn't gone away.
And on the positive catalyst side, what's the trigger to watch?
The Q2 earnings report is key. If NII comes in at or above $3.4 billion, it validates the trajectory toward the $14 billion full-year guidance. That would remove the last doubt about the NII recovery being structural rather than temporary. Net new assets are also worth watching. Schwab added $139.9 billion in core net new assets this quarter, and sustaining that level of organic growth drives the long-term asset compounding story.
So where does that leave us? Schwab just posted a record quarter by almost every relevant metric. Revenue up nearly 10%, earnings up 38%, trading volume at all-time highs, and the NII recovery story is empirically underway.
The single number to watch is quarterly net interest income. Schwab guided 13.9 to 14.4 billion for the full year. That implies sequential NII growth through 2026. If they hit that range, the stock at 91.50 is trading at 13 times forward earnings for a company with some of the strongest competitive positioning in financial services. That's cheap by any reasonable measure.
The risk is that the Fed gets more aggressive or cash sorting reemerges, and that guidance proves optimistic. But as of today, the evidence points to a company executing at a high level after one of the most complex integrations in financial services history.
A company that manages $11.7 trillion in client assets and is growing that number is not going away.
I'll leave you with a quote that feels right for Schwab. Warren Buffett once said, "The best business in the world is a toll bridge. You sit there and collect your toll."
Schwab is one of the closest things to a financial toll bridge in existence. $11+ trillion flows through their platform, and they collect a spread on every dollar that stays in a sweep account.
That's going to do it for today's episode of Charged Alpha, your deep dive into the Charles Schwab Corporation, ticker SCHW. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.